Hello students. Now let's practice the price variances and quantity variances. What we have studied is to analyze all the variances. So starting from the actual result and the flexible budget and the static budget. The difference between the actual result and the flexible budget is the flexible budget variances, and the difference between the flexible budget and static is the activity level variances, and the sum of these two variances are the static budget variances. But now we want to focus on the flexible budget variances and what is the components of the flexible budget variances. All the cost has the variances in terms of the price and the quantity. So if we have a result of the unfavorable or the favorable result in the flexible budget variances or any kind of the variances, it is comprised of the price and the quantity. If we purchase a higher price than we expected, then that is the price variances. When we use more the volume or the units, materials or the direct labor, then that is the quantity variances. And then the total cost of the variances in terms of direct material or direct labor is just the multiplication of these price variances and the quantity variances. But the result is a little bit obscure because, for example, direct material in this case of the medium company, the cost control performance report shows the variable cost of direct materials $80 the favorable, but we want to analyze what the components are. Is that the coming from the mostly the price variance or the quantity variances? How about the direct labor? This $5,500 unfavorable result came from coming from the price variances or the volume variances. So we need to identify so that we can give the right feedback to the manager of this direct labor or the department of the labor. So how do we calculate this price variance? As we discussed in the class, the price variance is also called the rate variance when we calculate the direct labor variances. And then this actual price per unit minus standard price per unit times actual quantity used is the price variance. We want to focus on the price part by multiplying actual quantity used. When we measure the quantity variances, also called the usage or efficiency variances, now we want to compare actual quantity used minus the standard quantity for actual output times the standard price per unit. We expect the standard price. Let's fix this standard price. Then let's compare this actual the quantity level and this standard level in the flexible budget. Okay, so let's go to the practice here. The standard direct material cost and then direct labor cost, we have a direct labor quantity, which is pound, and direct labor cost, which is hours. So the standard price per unit, $2 and $16 for the direct labor and $2 for the direct material. And then standard quantity per unit, 5 pounds for the direct material and 0.5 hour the direct labor cost. Okay, that is the standard information. And the units of output level achieved, we found 7,000, right? 7,000. Where is the 7,000? There you go, 7,000, which is the same as actual. So we use this 7,000 identical. And then let's find the actual information, which is a given. Compared with this direct material cost, we have a different number there. And then the direct labor cost also different. So in order to compare the standard price per unit of input and the standard quantity of output level achieved in terms of quantity, we need to calculate in this way. Okay, standard price per unit base is the same in the standard price for the direct material cost and the direct labor cost. The standard quantity of output level achieved, we need to calculate how $5, the 5 quantity times and output 7,000. So we got 35,000 pounds, 5 pounds per unit times 7,000 units, output units. So the total 35,000 pounds is the standard quantity of output level achieved. In the same way, 0.5 times 7,000. At the 7,000 activity level, the number of units output. So we got it. Now we can just apply this equation into here. Actual cost incurred can be calculated. Actual price times actual quantities. So actual price times actual quantity. So we got 69,920. In the same way, we'll just multiple. And then flexible budget. Also, based on the intermediate calculation procedure, we got the standard price and the standard quantity times 35,000. Then 3,500. So we got this, the actual cost incurred for the direct material cost and the direct labor cost. And the flexible budget 70,000, 56,000 for the direct material cost and direct labor cost respectively. Okay, then let's calculate the flexible budget variance. Okay, always we use AB as the absolute value between 2, then 80 and 5,500. So is that favorable or unfavorable? Yes, it's favorable because the cost of this total direct material is lower than the flexible budget. But the direct labor cost is unfavorable because the company spend more money on the direct labor cost. But it's not enough. It's not enough information. We want to know the component of this, the variances, which is the price variance and the quantity variance that result in this 80 or 5,500 unfavorable and favorable result. So how do you get it? Let's calculate the price or the rate of variance. Okay, once we got this from the calculation, we can just transfer this information. And the flexible budget standard price times the standard quantity, we can gather this information there. Okay, and then we need to calculate the standard price times the actual quantities. Why? As you can see this equation, actual price per unit times actual quantity used, and then minus the standard price per unit times actual quantity used. Exactly this equation, 2 equations. So standard price per unit, how do you get it? How do you get this? That's the calculation procedure we need one more time. It should be calculated. Right, there we go. The standard price, where is the standard price? $2 per unit times actual quantity. Now we use this. So 37,600. Also same way, $16 per unit for the direct labor, and then actual total hours. So 60,000. Now we collect all this, the calculation, and then let's calculate this variances between two. Then got it. So I'm going to just copy and paste this so that we can easily calculate. So is that unfavorable or favorable? Right, this is favorable because the actual cost and actual quantity is lower than the budgeted part. So it's favorable and is unfavorable. How about the quantitative variances? The difference between the part of actual and the budgeted part. Right, this is unfavorable. Also, this is unfavorable. And then the flexible budget, because that spend more money, both. And then the flexible budget, the direct material and direct labor variance is, now do you see the favorable, which one is bigger? Right, so we use this 3,680 for the first, and then quantitative variances, because the favorable unfavorable decision are different. So which one is bigger? Right, the price variance is bigger, so it's favorable. So we can analyze that this direct material cost for the uh, direct material cost, the variances are comprised of these price variances, which is the favorable, but in terms of the quantity, it is unfavorable. So this 80 got this totally two different result. So the price variance favorable means, the company used lower the material, the lower cost of material, cheap materials, but the company used the huge amount of these raw materials. That's why this unfavorable the result comes out. What about this direct labor cost? Direct labor cost is, now both are unfavorable, so we can just sum this up. So total is unfavorable. Okay, the flexible unfavorable, which is the same as what we calculated before, but when we analyze this direct labor cost in terms of the price variance and the quantity variance, we can say that, the company now spend more money than expected in terms of the direct labor cost, labor rates. They hired the expensive labor, and then they use this expensive labor a lot. It's really inefficient. Why? The reason why they hired expensive the laborers is that they are skillful. They have more skill. They can spend less amount of time than the cheap labor. But actually, they spend more time. That's why the quantity variance, which is our variances, is deteriorating. Okay, so they hired wrong the labor, a totally unskillful person, uh, even by giving a more rate. Okay, like this we can analyze. And then we have the case number 2, actual result for production of 8,500. Suppose now we have actual result for production of 8,500 units, and we have the bunch of this information for the new the direct material cost and direct labor cost and the actual price and the standard price and the standard quantity, but the different level 8,500, and then we want to see that what that is going to be changing in the variance report, the actual and standard data. Now we use this 8,500 output unit 85, Now, in the same way, we need to gather the standard price information from this table, and then standard quantity of output level achieved. We need to calculate $5 per pound per unit. $5 5 pounds. I'm sorry, 5 pounds per unit, and then the company produced 8,500 units. So 5 times 8,500. The same way, we got 4,250 for the direct labor cost. So let's use this equation once again. So actual cost incurred times actual quantities. Now just we can multiple of these two. The same way, direct labor cost as well. And then the flexible budget, standard price times the standard quantity. Also, in the same way, we got it. And then the variances is ABS of this deviation. So we got 100 and 1300, which is unfavorable and unfavorable. Both are unfavorable. But comparing between these two cases, unfavorable in total, the direct labor cost, sum of direct labor cost and the direct material cost is 5,420. Unfavorable, but both sum of this direct material cost and direct labor is now a little bit got better, but it's still unfavorable. But it's used the getting better is 1,400 unfavorable from around 5,420 unfavorable. So let's see what happened in this 100 unfavorable and 1,300 in terms of the price variances and the quantity variances. Okay, I will convert this 85,169, that flexible budget from there to there. And then standard price, where is the standard price times the actual quantities in order to calculate the price variances and the quantity variances. So standard price per unit $2 times the actual quantity. What is the actual quantity? There we go, the 46,000. So we got 92,000 for the direct material cost. And then the same way, $16 times 4,125 hours total. So we got these numbers, and then let's calculate the price variances. The same way, ABS, the difference between two, we got the absolute value, and let's just sum up. Let's just copy and paste. So we have these variances, and then let's analyze of these variances. Is that favorable or unfavorable? Right, it's favorable, huge favorable. And then how about the quantity variances in the direct material cost? Quantity pounds is unfavorable. That means that again, the company now use very cheap materials and then use a lot of materials of this cheap direct material cost. And then we have the favorable, which is bigger. Okay, the unfavorable is bigger. So let's start from this. And then, do you see? We put unfavorable. 100 unfavorable. Now comparing this 7,000 activity level, it turns to the unfavorable situation, unfavorable the variance, but it's not a big deal. not a big deal. Here, the direct labor cost is favorable, unfavorable, and also here 2000. Now we found out the favorable here, and then now the difference between two is 1300 because the unfavorable is greater than the favorable, so it is also unfavorable. So what is this case? Now when the company produce 8500, which is very higher than this 7000 activity level, now the direct labor cost is now unfavorable. That means that they hired expensive labor, but now they use the lower hours when they produce 8500. So now it's more efficient. Okay, so the reason why they hire the expensive the labor is that they can reduce the time consuming. So when they produce more product, then okay, this skillful labor use less hour. Okay, so when it comes to the direct labor cost, the company would prefer to produce more product. Okay, this is it. See you in the next video clip. Bye bye.